At least not anytime soon. Hey, what's up? It's Benj here with Triple Cord Real Estate. And in this video, I want to give you 4 reasons why I don't think we are in a housing bubble like we were back in 2008. But first, let me give you a snapshot of the Boise housing market as it stands today. So the median sales price came in at $540,000 last month in Ada County, and that's 20% more than it was in January of 2021. Now, as I've been saying, prices have been leveling off since July of last year. The median actually dropped slightly from December to January. It went down from 546,000 down to 540,000. A lot of people have been asking me about supply lately. Now, it is true we have been seeing an increase in inventory. Last month we had 63% more inventory than we did a year ago. But if you look at this chart, you'll see that last month we had 441 homes for sale in Ada County. Last January we had 269, so definitely an increase there. But notice where we were at before the pandemic began. About 1,115 homes for sale in Ada County, and the year before that, almost 1,400. So even though the inventory has been steadily going up, we still have about 60% less homes for sale than we did before the pandemic began. Now, with the leveling of prices, we also have been seeing the average days on market go up steadily. I made a graph that charts the average days on market throughout all of last year. And you'll see that last January, we were at about 19 days on average, and that went down to 10 back in June. And since then, the average days on market have slowly been going up. Right now, we're at about 37 days on average. Now, when it comes to pricing, most homes are closing right at around the list price. Last month, the average home sold for 97.3% of the asking price. So most of them were selling just slightly under the advertised price. And anecdotally, I've been seeing that in the transactions that I've been a part of as well. Over the past couple months, one of my transactions closed for under the list price. 2 of them closed at the asking price, and then 2 more closed for slightly above. Now, when it comes to competition, it really depends on the property. In one of my transactions that just closed, my buyers were one of 17 that had put in a bid. Now, they did end up getting their offer accepted, but they had to pay their maximum price. On the other hand, other clients of mine who are closing shortly, they had submitted the only offer on that house, and they ended up getting it for less than asking. And then let me give you one other statistic that compares new homes to existing homes. On average, home prices for new construction are increasing more rapidly than for existing homes. So the median for existing homes last month was $515,000, which is 18% higher than it was 1 year ago. And the median on new construction in January of 2022 was $588,000, which is 28% more than it was 1 year ago. Now, how does all of this compare to what we've been seeing in the housing market across the United States? As I've said in my videos, what we see in the Boise housing market is a microcosm of the United States in general. Home sales across the US are at their best in 15 years. We sold more homes last year than any time since 2006. And Americans' net worth has risen $31 trillion since the beginning of the pandemic. That's the largest 18-month increase in US history. Now, $5 trillion of that is in home equity, and that's an important point that I'll come back to in a moment. So across the United States, we've seen some really solid numbers in the housing market, but an important factor is also the rising house prices. Across the board, house prices have risen 25% since the start of the pandemic. And on top of that, mortgage rates have also been increasing. And so that has been putting a strain on buyers. Now, this increase in house prices and interest rates works out to be about a $500 per month increase on payments across the United States. So as you can expect, this is affecting buyers, and in particular, first-time home buyers. Currently, first-time home buyers account for about 30% of the total sales, which is down from 35% before the start of the pandemic. So, as you would expect, this has made the rental market really hot. Rent prices have really gone through the roof over the past several years, and rental vacancy rates are at a 40-year low. So, pulling all of that together, what that means is that if you own property, you are in a good position. What this puts a strain on, though, is on buyers that are entering into the market for the first time. So, does this mean that it's all going to collapse? Are we on the verge of a bubble that's about to burst like it did in 2008? I don't think so, and I have 4 reasons why I don't think we're in the same situation. Now, before I move on, if this video has been helpful, hit the like button so more people can see it. Also, if you are thinking of moving to the area or you have any questions, feel free to shoot me a text or send me an email. My info is in the description below and on the screen at the end. Number 1, we're seeing low inventory and high demand all across the United States, including here in the Treasure Valley. Nationwide, we have a housing shortage of 5.5 million units. So to fill that gap, we would need to build 2 million units per year for the next 10 years, which amounts to a 60% step up in production, which is gonna be quite hard to do. Now with that in mind, look at this chart that illustrates the month's supply of housing inventory before the crash. In 2007, nationally, there were about 9.6 months worth of supply. That number went down to 9.4 in 2008, then in 2010 it was at about 8.5 months. Today we have about 1.8 months worth of supply across the United States. And in Boise it's the same situation. As I mentioned earlier, we only have about 0.3 months worth of supply here in the Treasure Valley. So high demand and low supply, to me, is not a recipe for a housing collapse. Number 2, lending is much more strict today than it was back in 2008. Back then, the mortgage standards were much more relaxed. It was much easier to get a loan, in particular if you had bad credit. So back in 2008, people were taking huge mortgages on houses that they simply couldn't afford. This next chart illustrates the volume of loans in billions that is given to people with a credit score of 620 or less, which is considered to be poor credit. So as you can see, leading up to the crash in 2007 and 2008, there were about $300 to $350 billion in loans given to people with credit scores of 620 or below. Notice where that number is right now. It's about 2/3 of where it was back then. And what that means is people who are getting loans today are much more qualified, more financially stable, and that means there's gonna be more stability overall in the housing market. Number 3, the foreclosure situation today is much different than it was back in 2006 or 2007. Many fewer people today are facing foreclosure than they were back then. And the reason is people today are equity rich. One of the advantages to these big price increases that we've been seeing over the past several years is people have been gaining equity in the homes that they own. In fact, over 40% of homes in the United States have more than 50% in equity. Now that's pretty significant because if somebody gets into financial trouble, they are much less likely today to go into foreclosure than they were back in 2007. Prior to the burst, people were taking out lines of credit on their homes and they had much less equity in their residences. So when they got into financial trouble, oftentimes they were underwater and so their home was worth less than what they owed on their mortgages. So what people did is they simply walked away from their homes and the banks were left with homes that were worth less than their mortgages. So the banks in turn had to get rid of these homes, so they sold them at a greatly reduced price, and that led to a devaluing of properties across the board. But with the equity that most people have in their homes today, I don't see that happening again anytime soon. Now, the 4th reason why I don't think we're in a housing bubble like we were back in 2008 is actually the most important because it relates to the Treasure Valley in particular. Now, there's a lot to say on that topic, so I ended up publishing a whole separate video on that. So I recommend that you click on this video right here so that you can get the full scoop.